You can convert as much as 97% of that active income by changing it from active income for your LLC into passive income for the trust. So in monetary terms, we've taken $200,000 of ordinary income, normally taxed in the United States at 32%. We've sent $194,000 of that over to the trust, leaving you only $6,000 that's taxable in your LLC after we get those two expenses over. Hi, this is Dohn Thornton. I love this invitation to be on the S Factor. I am one of the country's leading authorities on this amazing trust and how people can save almost all their money on taxes and be able to protect all of their assets. I have been a real estate investor for 20 years. I use this strategy myself. And for all my success in business, I would say my S factor is I never quit.
Hello, Dohn. Welcome to the S Factor. How are you today?
I'm doing fantastic. I'm so glad to be here.
And we are glad that you are here. We're going to be talking about how to legally reduce all our taxes. But before that, let's get to know you a little bit. Just give us the 2-minute version of some of the things that you have done and some of the things you're doing right now.
Okay, well, I have, I guess I've been a former world traveler in the sense that before COVID hit, I spent most of my time in Europe and in Russia, more so than I did in the United States. I was way back in the day, back in my 20s. I spent 2 years in Finland, learned Finnish for some weird reason. Never really used it again, but I always wanted to go to Russia for some reason. And I think it had to do with the fact that when I was a teenager, like 7th, 8th grade, they offered Russian in middle school. And there was a lot of Soviet immigration back in the 70s in my hometown, St. Louis. And I was able to meet a lot of them. I wanted to speak Russian so bad, but I didn't know it yet. So I said, you know what, one day I'll go to Russia. I did, worked at the embassy for a couple of years. And then next thing you know, I spent the next 15 years over there, got married, have kids, and now a grandson. After that, I spent a dedicated last 20 years being a real estate investor, becoming one of the best short sale investors in the country. And like you said about the tax thing, I learned about how to legally reduce my taxes as a business owner to almost zero, and decided after COVID that it would be a great opportunity to share that knowledge with people like myself.
Excellent. Thank you for that. And we are going to straight away jump into the whole tax space. And
Sure.
Before we do, I think we should preface this by saying that this is not financial advice.
Exactly. This is for informational purposes only. I am not a licensed CPA or attorney. And I would urge anyone to seek licensed advice before they enter into any financial transaction.
Yes, perfect. So let's start talking about your strategy. First of all, just explain to us in detail, if you will, what is your strategy, and then we can talk about how you came up with it and a few other things.
At its core, it all revolves around this trust. It is a unique trust. It is called a non-grantor, irrevocable, complex, discretionary spendthrift trust. Like I said, it's very specific, and it's a very narrow niche on its use. It has been used by the ultra wealthy for well over a century, if not longer. In fact, when the U.S. tax code was first implemented or instituted in the 1930s, there was a special IRS code that has to do with this kind of a tax, because that's where the really wealthy were keeping their money, and they wanted to make sure that they had an ability to shield most of their money from taxes. And so this trust has a special relationship with IRS Code 643 that allows all this legal tax reduction to take place. Now, it was a closely kept secret. Most of the ultra wealthy did not share it, except people in their clique and their club, right? It was like the popular kids in school. They didn't want to tell those of us who weren't popular about what their secrets were. But the last 3 or 4 years, especially last year, is starting to get traction. People are starting to get to know about it. I learned about it a year and a half ago. I'm almost on my second year of learning about this, and it is absolutely the real deal. And for my business, it's been wonderful as a real estate investor. And, it's great for anybody who's not a salaried employee. Unfortunately, if you have a salary, we can't help you with this. But if you are a business owner, if you're a real estate investor, if you have a 1099 career, if you're a commission salesperson, anybody with those kinds of income streams can definitely be helped by this. And so there are basically two types of income there's three kinds of income that this can really reduce your taxes legally by an immense amount. The first one is any kind of passive income. So passive income, we're talking about if you own property and you rent it out and you're getting rent or leases from your rental properties. That is passive income. If you have stocks, bonds, any kind of passive investments, when that money comes in to your trust, that's also passive income for the trust. Now, the other kind of income you get is when you have something of value that you sell for a profit. And normally when you do that, like say if you have an investment property and you decide to sell it, well, whatever profit you make is going to be usually, unless you have a legal way to get around it, is pay capital gains tax. Crypto, if you have precious metals, if you sell an investment property, anything of value that you sell for a profit, a business, for example, then you're going to have a capital gains tax event. And then finally, the other source of income is what we call active or ordinary income. That's when you get a commission. For example, if you're a realtor and you sell a house and you get paid a commission, that is active income. If I am a 1099 employee or contractor, the company pays me or pays an LLC, that is active ordinary income. Normally, that's taxed at 32% if you make over $165,000 a year. This trust, in conjunction with an LLC, you can convert as much as 97% of that active income by changing it from active income for your LLC into passive income for the trust. And I'm being very simple and basic about this. Obviously, there's nuances that we want to get into, but I just want to explain, really what those three categories are and how this trust. Well, first of all, if it's capital gains, you'll pay no tax on that. If it's passive income, you're not going to pay any taxes on that either. And you can reduce any active income by as much as 97% by using this amazing trust.
Okay. All right. Excellent. So let's talk about the practical application of this, if you will.
Sure.
And if you would indulge me, I'd like to talk about a specific example, if we can. Okay. Let's just say for myself, although I don't live in the US, but let's just say I live in America. I own a moving and storage business, which I actually do. And let's say I have made 200K of sales this year, let's say, out of which, let's say, I've made about 60 grand in profit. That's just profit, right? So from here, how do I actually go about reducing my corporate taxes?
Okay, this is what you would do. Before you start anything, what you would do is you would sell all of your business assets into the trust, okay? And then that way the trust owns everything, both tangible and intangible assets. Because people sometimes forget about intangible assets. I mean, what your know-how, all your strategies, your secrets, your database, your network, all of that, those are assets that should be monetized and sold into the trust as well. So when the trust holds all of your assets, okay, then you're going to need to be able to run it through another entity. So what I would do, if you were in the United States, you would set up a limited liability company, an LLC, and then you would have the trust be a 90% limited member of your trust. So you, as the business owner, you would own the LLC, but you would only have 10%. You would control it, but you'd only have 10%. But now that your assets for your moving and storage company are in the trust, your LLC would need to have access to those assets to be able to generate revenue. So the trust will lease those assets to your LLC. So now you go about and you run your business like you would normally. You get contracts in, you make money, you deduct all of your deductions, you expense everything out. And just for the sake of easy math, let's just say that after you've done all of your deductions and your expenses, let's say that you have $200,000 left over, okay, as your profit. Now, with this strategy, you have two more expenses that you have to deduct to bring your tax liability down to almost zero. The first thing is the lease. You got to pay for that lease, right? Because the trust leased that to you. It didn't do it for free. You got to pay for it. So in America, the Internal Revenue Service will allow a company to pay up to 70% of their net income as a lease payment. So your LLC would transfer 70% of that $200,000 into the trust. Now that would drastically bring down your net income, right? Because you've transferred 70% over there to the trust. Now you only have 30% left. But remember, the trust is a 90% member of your LLC. It needs to get paid as well. So in America, we have this thing called a K-1 distribution, which means that if you have an equity position somewhere, then a K-1 is the name of the transfer from, let's say in this case, your LLC over to the trust. So 97% of your $200,000 profit in your storage moving and storage company has now been transferred over to the trust. So in monetary terms, we've taken $200,000 of ordinary income, normally taxed in the United States at 32%. We've sent $194,000 of that over to the trust, leaving you only $6,000 that's taxable in your LLC after we get those two expenses over. Now, I think you can see how you won't pay hardly any tax at all on that amount, right, for your LLC. And the $194,000 that went over to the trust, well, because it's now passive income for the trust, as trustee, you can declare that to be an extraordinary dividend for your trust, and in accordance with Internal Revenue Code 643, that's not a taxable event for your trust. So no taxes will be paid on that. And there you go. That's how it works.
Wow. Okay. And as you have rightfully mentioned the IRS tax codes, so obviously this is a legal way or a legal channel of doing this,
yes.
Correct?
Yes. The trust is actually, we are a licensed company for a law firm that actually has had the trust. It's called the Master Trust. They've had this, the law firm has had this trust for almost 50 years. It's been defended many times. It's always won. In fact, there is a letter called the IRS Trust Private Finding Letter, and that's a document that the IRS will do when someone goes to them and an analysis is done by the IRS about whether what someone's trying to do is legal or not. They go through, analyze it, go through it with a fine-tooth comb, and then they make their decision. Well, our trust is the only one that has that type of document where it clearly states from the IRS that this strategy with IRS Code 643, this type of trust, and what we talked about is legal. So
okay. All right.
we're on very solid ground here.
Okay. All right. Perfect. Are you aware of any court cases which has involved this kind of a trust?
Well, this is and I don't want to get too deep into the weeds about this, but this is what we call a contract law trust. There are two types of trust, two types of law in the United States. We have contract law and we have legislative law. In a nutshell, what this means is that if any kind of legislative body, it could be Congress, it could be a state legislature, it could be county, it could be city, if any type of entity owes its origin to some kind of legislative act, and that is called legislative law. And I would say probably 99% of the trusts out there are legislative law trusts. Whereas this is a contract law trust, because in the U.S. Constitution, in Article 1, Section 10, it says that no law shall impair the obligation of contracts. And the biggest Supreme Court ruling about how a contract law is different than legislative law was in 1911. It was called Elliott versus Freeman. And that decision had to do with a federal tariff. And there was a dispute about, what kind of entities did that tariff cover? And the Supreme Court came out and said it only covered legislative entities like companies, like corporations and so forth. And they specifically said in that ruling that trusts, like this trust, are in the realm of equity, and this law did not apply to them. So a contract, because we have a very sacred tradition in the United States about how contracts are pretty much sacred when it comes to legislation. So now no entity can tax a contract law trust like ours. They can't come in and impose any kind of regulation on that trust. So basically, after that ruling, that basically solidified this trust status, I want you could call it, as a contract law trust, and it's been that way ever since. I would say that I talked to the law group, and this particular trust has not even been audited in the 50 years that they've had the trust, because it all the T's have been crossed and all the I's have been dotted, and it's never once been penetrated.
All right. That's good to know. One of the final things that I want to know from you is that a lot of people are obviously, they don't have a tax strategy. Most people do not, in my opinion, right? Of course, I don't have hard data to support that, but that's just my opinion. Now, in terms of building out a tax strategy on, obviously saving taxes and things like that, what do you think are some of the most common mistakes that people are making?
Well, I can only talk about my experience in the United States, but I can tell you this, that for U.S. viewers and listeners, I will say this, that as a small business owner for 20 years, a very successful one, I have two of the biggest leaks in my profit bucket. If I got all this profit coming into a bucket and just two big leaks that are just pissing it away, it would be taxes and insurance, health insurance, especially for myself as an owner and for any employees I might have. So I would say that if you're not plugging those two leaks, then you're not nearly as profitable as you can be. So I would say that the most important strategy that as a business owner I would have is to plug those two leaks. I would make sure you bring your healthcare costs down as much as humanly possible, and I do have a program for that. For people who are interested, I can let you know about that, and the trust as a tax strategy to be able to, basically, for most people, unless you're making tens of millions of dollars, probably not going to be paying that much in taxes with this trust. So focus on those two costs, expenses, your business, and if you can solve those, then you're going to keep much more of your profit, which is really what we're in business for. It's not revenue, it's profit.
Very well said, and I like the part that we are in business to make profit, not revenue.
That's right.
Right. Excellent. Especially for small businesses where, we've got so many issues. We got problems with our resources, and you know what? Every dollar counts. All right.
Absolutely.
Perfect. So Dohn, if people wanted to find you, where would they look?
Well, what you can do, I'm all over social media. You can certainly find me there. My name is very unique, Dohn, Thornton, Thornton. So you can find me there. For those of you who are in the United States, I am a very open person. I will give you my cell phone number. I mean, text me. It's 407-902-7827. If you're overseas, I can't help you. This is just a U.S. tax strategy. But if you're in the U.S., 407-902-7827, you can find me by that same number on WhatsApp.
Wow, you're giving away your phone number on a platform like YouTube. All right, so I wish you all the best
I've
with that.
never had. Uh, I'll just say one last thing.
Mhm.
I've been the same number I have had out for 20 years. It's out there, so
Okay.
I don't care. I mean, all I ask is text me first. That's all.
Right. Text you first. Absolutely. All your links will be in the description below. So if anyone wants to reach out to Dohn, feel free to do so. And he's the most open person actually I've ever met because he's given out his phone number. I don't know anyone else who would do that. So there you go. Dohn, thank you so much for your time
Appreciate
today.
it.
Yeah, I wish you all the best, sir.
You too.